When it comes to purchasing a home, there are numerous financing options available to buyers, and understanding the details of these loan types can make a significant difference in the overall cost of your mortgage. Today, we are diving deep into three of the most popular types of home loans: FHA loans, conventional loans, and VA loans. Our focus will be on breaking down their monthly payments, the fees associated with them, and how each of these loans impacts the overall affordability of your home purchase. Whether you are a first-time home buyer or an experienced one, understanding the nuances of these loan types can help you make a more informed decision. Let's start with FHA loans, which are backed by the Federal Housing Administration. FHA loans are often seen as a good option for first-time home buyers or individuals with lower credit scores. One of the key advantages of an FHA loan is the lower down payment requirement. While many conventional loans require a down payment of at least 20, an FHA loan only requires a 3.5 down payment, making homeownership more accessible for those who don't have a significant amount of savings. However, it's important to note that while this lower down payment is attractive, there are additional costs that come with an FHA loan, most notably mortgage insurance premiums, or MIP. MIP is a type of insurance that protects the lender in case you default on your loan. FHA loans require this insurance for the life of the loan if you make a down payment of less than 10. The monthly MIP payment can add a substantial amount to your monthly mortgage payment, making your overall monthly cost higher than it might be with a conventional loan. In addition to monthly MIP, there is also an upfront MIP that is paid at the time of closing. This is typically 1.75 of the loan amount and can be rolled into the loan, which increases the total loan balance. While FHA loans offer the benefit of easier qualification and a lower down payment, the additional costs associated with MIP can make them more expensive over time. So, while the upfront costs are lower, you may end up paying more in total interest and insurance over the life of the loan. Now let's look at conventional loans, which are not backed by the government, but instead are offered by private lenders such as banks or credit unions. These loans are the most common type of mortgage, and they come with a few distinct advantages, as well as some additional requirements. One of the most significant benefits of conventional loans is that if you make a down payment of 20 or more, you can avoid paying private mortgage insurance PMI. PMI is similar to the MIP on FHA loans in that it protects the lender in case you default on the loan, but it is not required once you have built up 20 equity in your home. For those who cannot make a 20 down payment, PMI is still required. However, unlike MIP on FHA loans, PMI can be canceled once you reach 20 equity in the home, which can help lower your monthly payments over time. If you are able to make a larger down payment, a conventional loan might be a better option, as the monthly payments will generally be lower, especially if you can avoid PMI altogether. Conventional loans offer more flexibility in terms of loan amounts and repayment options compared to FHA loans, and the interest rates can be more competitive, especially for those with higher credit scores. However, the requirements for qualifying for a conventional loan are stricter than for an FHA loan. Typically, you'll need a higher credit score to qualify, and the down payment requirements can be much higher if you want to avoid PMI. Additionally, for borrowers with lower credit scores or small down payments, the interest rates on conventional loans may be higher than those on FHA loans, leading to potentially higher monthly payments. Finally, let's explore VA loans, which are available exclusively to military service members, veterans, and eligible surviving spouses. The VA loan is perhaps the most beneficial loan type of all, as it offers no down payment, no PMI, and often comes with the lowest interest rates available. These loans are backed by the U.S. Department of Veterans Affairs, which means the government guarantees a portion of the loan, allowing lenders to offer such favorable terms. One of the most significant advantages of a VA loan is that it eliminates the need for a down payment. Unlike FHA or conventional loans, where you must pay at least 3.5 or 5 upfront, VA loans offer 100% financing, meaning you can purchase a home with no money down at all. Furthermore, because there is no PMI required with VA loans, your monthly mortgage payment is typically lower than it would be with an FHA or conventional loan. This can significantly reduce your overall housing costs. However, there is a funding fee that is charged by the VA, which helps cover the costs of the program. The funding fee can be financed into the loan amount or paid upfront at closing. The amount of the funding fee varies depending on factors such as whether it's your first time using a VA loan, your service history, and whether you are making a down payment. While this fee is an added cost, it is generally much lower than the ongoing costs of PMI or MIP. VA loans also tend to have lower interest rates than both FHA and conventional loans, further reducing your monthly payments. The eligibility for a VA loan is limited to those who have served in the military, which makes it an incredible benefit for those who qualify. However, because of the extensive benefits, VA loans are not available to everyone, and if you are not a veteran or military service member, you will not be eligible. So, when you are considering your mortgage options, there are several important factors to take into account: the size of your down payment, your credit score, the loan type, and the additional costs associated with each loan. FHA loans are ideal for those who have a smaller down payment and might not have perfect credit, but they come with the added cost of mortgage insurance. Conventional loans offer more flexibility and potentially lower monthly payments once you reach 20 equity, but they require a larger down payment and better credit. VA loans are the best option for those who qualify, as they come with no down payment and no mortgage insurance, but they are exclusive to military service members and their families. Choosing the right loan is not just about the down payment or interest rate, but about understanding the full picture, including how much you'll be paying each month, the long-term costs of mortgage insurance, and the fees involved. It's crucial to work with a knowledgeable mortgage lender who can help you evaluate your options based on your financial situation and future goals. Remember, the best loan for you is the one that fits your unique circumstances. And now that you know the differences in payments and fees between FHA, conventional, and VA loans, you're better equipped to make that decision. Be sure to do your homework, ask questions, and shop